Well, good afternoon, almost afternoon here in Southlake, Texas. Bill Riley with Riley Private Client. Today we're going to talk about some kind of the past and looking at the future. We've had a lot of things happen, everything from the poor people in Florida all the way to what's going on in the economy, hackers, and now we had an earthquake last night. So there's a lot of things happening, and I want to go over some of it, and we're going to be talking about what the effect of these things have on the markets. So the theme, and this will be an ongoing theme for the next few months, and I'm going to cover different topics that I'll speak about and go more into depth, is going to be what's driving the stock, bond, and housing markets right now. I get a lot of questions about why is everybody buying a house, or why is everybody wanting to invest in the stock market? Is it a good time? So let's talk about those topics, and I'll kind of hopefully be able to give you some insight into that. A famous author by the name of James Playstead Wood, I don't know how he got that middle name, but he did, once wrote that the thing that most affects the stock market is everything. Everything affects the stock market. The point rings true that there are so many factors that impact markets. Every day, something will happen that will affect markets. Here's a good example. The night before last, that about 3:30 in the morning, got word that the Olympics in Japan, that they decided not to let anybody come. The athletes will be there, but there'll be no audience because of the new spike of the virus that's mutated. That shook the markets. That's why we had a big sell-off yesterday. So everything affects the markets, things that probably shouldn't, but do. Now, just off the top of my head, here's some of the things that I look at. Earnings. We're coming into maybe one of the strongest earnings seasons we've had in years. The economy itself, interest rates, inflation, the Fed, government spending, investor risk appetite, innovation, demographics, dividend yields, stock buybacks, price trends. And there's a whole lot more. I mean, things that you wouldn't even think about affects the market. It's not just one thing that affects the market. So the Fed raises rates eventually. Will that really affect the markets? No, it'll be other factors too that will affect the markets. But there are certain times where a single variable seemingly trumps all others. And that's where we're kind of going to talk about and kind of expound on as we go forward. And this will be a series of these. I'll talk about each one of these topics, maybe two at a time, as we go through this summer and into the fall. So let's think about this a minute. The reason that stocks are going up is because people want to own stocks. That's basically it. People want to own stocks, so it drives the price up. So they keep buying stocks. The reason housing prices are soaring is because everybody wants a house. So they keep buying houses. The reason bond yields are going up and it's remained stubbornly low is because people want to own bonds. So they keep buying bonds. Now here's something that's kind of the antithesis of that, is that Robert Shiller, who's a Yale professor, and I follow his work and read his books and the irrational exuberance and all this stuff. He has a PE ratio. Now what a PE ratio is, the price to earnings ratio. That's how you price what the price of the stock you want to buy. The higher the price to earnings means that if the price is more than the earnings going forward, you may be overpaying. That's why a lot of value stocks have done well this first part of the year, because the price to earnings ratios were lower than your big cap, what they call the FANGs. However, right now we're at 37 times earnings. That's the highest valuation in history for this measure. I only saw this one time, a couple of times before, prior to year 2000, and incidentally, prior to the year 2008. So PE ratios are important, but all these other factors come into effect, and people kind of say, set them aside and don't pay attention. Investors really don't care because people want to own stocks. It's a topic. I mean, Robinhood, which has got themselves in trouble a couple of times, everybody talks about it. A lot of people don't even understand what it is. It's a trading platform, and they give you ideas. But it's a big topic. Every time I go somewhere, or I attend a meeting, or just a social event, I said, what do you think about this Robinhood? Well, I tell them this is a gambling proposition. That's all it really is. Kind of give you reflections of the past. How many of y'all remember E-Trade and the baby sitting in his crib trading in stocks? Think about that a minute. Isn't that really what we're getting here now? Now people say no, and that's not Robin Hood, and we have all that. It kind of is, because most people that are on Robinhood have small accounts and they're trading options, which options are only for the very professionals. I was an option trader. Don't do much of it anymore, but back during my heyday, we did very well trading options, especially with the volatility in the market. But it's very complicated. And it has to know what you're doing. And you just can't take the advice of someone, punch it up on your phone, and think, I'm going to make all this money. Individuals invest also on a set schedule. The reason stocks keep going up is people are upping their allocations to the 401ks, which is a good thing. But when they take your money out of your check and they send it to the 401k company, they're going to buy stocks if that's what you've allocated. Whether the market's up, whether the market's down, whether the economy is flat, whether the economy is roaring. You're going to buy stocks, so that drives prices up. Young people, I'll tell you what really happened and why some of this Robinhood and some of these things have happened, is everybody got bored during the pandemic. They wanted something to do. DraftKings, well, they couldn't bet on the games or the sports because there were no sports. Nobody had anything. So they went to trading stocks like it was a game. And they kept buying them, driving up prices. 10,000 baby boomers are going to retire on a daily basis. That's a lot. They have some 70 trillion in wealth, and they have needed to protect some of it. So even though rates are generationally low levels, high quality bonds still offer protection for the capital in the short term. So that's when they keep buying bonds, which isn't a bad idea. But that's where all this is coming on. I talked to my banker, and I also heard the head of Bank of America said that they have more cash in the average person's checking account than they've had in years because of the stimulus, because they haven't spent any money. I mean, where did you go during the pandemic? You didn't even spend any money. You ordered pizza. The government probably can't afford to let interest rates get too high because of all the debt we're taking on. Can you imagine if we went back to the normalized rates and we were trying to pay the debt off that they're creating? It won't work. They will have to raise taxes. And that's a whole different subject. Much of the demographics is that early to mid-30s is the time when people start to settle down. So they start buying houses. I have good friends in the real estate business, and in fact, one told me she had the worst quarter she'd ever had this first part of the year because there was no houses to sell. There was no inventory. Everybody wants them, but you can't find them. That's why prices go up. The pandemic set in motion a boom in the ability for many people to work from anywhere. People now are able to work remotely and not to be tied down to the biggest, most expensive cities. So you see a migration. I've thought, now fortunately I live pretty close to this office, so it's not a big deal to me. But I have a lot of friends in this business that basically when I talk to them, they're at their vacation home in Colorado, they're on the beach, and they're sitting there in their little cabana on their laptop doing a Zoom and giving me information. Pretty cool. In my day, you were expected in that office on the Squawk Box calls at 5:30 in the morning. Now, you just log in. So they keep buying houses. And they keep buying houses with offices and fancy basements, and that's kind of part of the selling point. When I moved from a larger home to a smaller home, one of the primary things I wanted was a theater room. And this was still 12 years ago because I enjoy watching movies on big screens and watching my football games. So I had my little man cave. It was a big selling point. Now it's, can you equip this with Zoom? To kind of sum it up today, here's where we are. We're going to be talking about a lot of the things I mentioned and go into this and see how the effects on the market are accumulation of things, not just one thing. People, you will hear the guys, the talking heads, I call it, on the news. They'll say, well, interest rates, the reason the market went down is because interest rates went up today, or the reason this happened is because of this. No, it was because other factors happened that caused that to happen. It wasn't just one thing. How many of you have heard the Wall Street professionals in the past decade bemoan the fact that stocks, bonds, or housing are in a bubble? Bubbles are funny. I've been through several of them. And here's the real problem. You really don't know that you're in a bubble until it bursts. And then everybody says, we're in a bubble. But you really don't know while it's going on and happening nobody says we're in a bubble. So this is part of the risk appetite we'll be talking about too going forward. As I mentioned before, we have a program called Riskalyze, and it's going to be very important for people to, and I'll say it again, to measure the amount of risk in your portfolio. Because if it's out of line with what your appetite is, it looks great when it's going up 20 or 30%, but it looks really bad if it drops 20%. Now, another thing I'm working on, and you'll hear more about, is I'm trying to create an income portfolio. Because a lot of my clients are starting to retire. It's very important. It's important to me, is that where do we get our income from? So I put together that model, and I'll be referring to that, and we'll probably do some special programs on that. I think you'll find it interesting, and it's something that's needed because, you can't really live off the growth in your account. People think they can, but really you need something that you're creating a dividend stream, an income stream, so you're working off other people's money, I call it, not your money. So we'll sum that up today. I hope you log in for the program next week, and you'll be seeing a lot more information coming from me concerning these topics, because it's very important to me that we all made pretty good money in this market since the bottom. Now the big job, keeping it. I'll sign off here, and again, if you need to contact me, it's 817-870-4680. You will also have our email on there, and please go to our website. You'll start seeing a lot more stuff. We're revamping that and really working hard to make that more, a lot more information on it. And it's www.rileyprivateclient.com. So thank you again for listening. I hope you all enjoy this. And don't keep me a secret. Pass this on to other people. I've got a few texts and stuff from other people. Hey, such and such sent me this. I really enjoyed it. Get me on the list. So please do that. So I'll sign off for now again, and I hope you enjoyed it, and I'll see you on the turn.